Tom Lee, everybody's favorite bull, just went on CNBC 2 hours ago. I want to react to what he was talking about here in this video today, okay? All right, let's get into this.
About taking things like, say, a job print or CPI and arguing that it's an opportunity if there is a dip. Is it a harder call when it does involve geopolitics?
It's definitely a harder call because the scope of the path this escalation can take place is unknown. But at the same time, we can look at sort of past episodes and past war instances or conflicts and understand how markets react and where positioning is. And I think that's what's giving us some confidence today, that there's a lot less leverage now. And I think the Fed's in a very different position where the Fed could be supportive. And that's why I think, as uncertain as it feels right now, I think this dip will be bought.
Does it create downside risk for your year-end target, let's say?
I think when you move beyond the 1 month, even 3 months, or even 6 month timeframes, I don't think that these actually affect the trajectory because, the drivers of our year-end target are this recovery in corporate profits, the upturn in business confidence measured by ISM, the fact that consumer leverage is still quite low, and that monetary policy is actually supportive of the business cycle. So I think these things all...
I got to push back against Tom Lee here, my fellow bull, okay? Listen, he keeps talking about consumer leverage is low. That's just not right.
Confidence measured by ISM, the fact that consumer leverage is still quite low.
I just don't agree with that based upon the data. We might be looking at two different data. I do not believe that consumer leverage is low. I also don't think it's as epically bad as the bears make it out to be, okay? So I think Tom Lee's version of where consumer credit's at right now, and I think the bears' image of consumer credit right now, I think they're both inaccurate. I think we're somewhere in the middle. I do not think consumer leverage is low right now, based upon the data, based upon the facts, and I also don't think it's certainly some insane number. People want to point out credit card debt; it's higher than it's ever been, but guess what? Almost every year, it's higher than it's ever been. The only time usually credit card debt goes down is if you're in a massive recession, because then people can't get loans and those sorts of things. But in any sort of normal economy, credit card debt goes up year after year after year, 2017 into 18 into 19. That's the way it goes, okay? Only time you usually see it go down is when you're in a big recession.
That monetary policy is actually supportive of the business cycle. So I think these things all are still at play between now and year end. And, I think our 5,200 target is too low, but I think it's still too early for us to raise our target as well.
Interesting.
Yeah, I read your note over the weekend. I cited it.
Stocks will ultimately emerge higher after de-risking. Tax-related selling is already in place. Expect a possible bottom turning this week. Now, something to do keep in mind, right? Today's April 15th, tax day, right? The thing that's important to remember is the famous saying in the stock market, sell in May and go away. And so some people could already be, selling out of some stocks, kind of expecting a volatile, tough summer. And summertime, many times you got to understand, is actually a great time to buy stocks. Just because the stock market is downtrending in summer doesn't mean you shouldn't be buying stocks. It's actually usually the best time to buy stocks. And there's other months that are great for the stock market. November many times, December, January. I believe March is usually a pretty good month for stocks, if I recall. But, if you're thinking about buying, right, maybe those are good months to sell. Usually you want to buy when the market's weaker, and usually in the summertime you get a lot of weakness in the market.
It does rest on this idea that the Fed is in a very different mode, and as you referenced, they're sort of in easing mode. But the story, Tom, has been that they are not going to be able to ease so easily or so quickly, and today's retail sales data only adds fuel to that fire. So I do wonder how much of your thesis depends on the Fed cutting this year.
Sarah, I think it's important for the Fed to be dovish this year. And in terms of how many cuts they do, I know there's going to be a lot of debate about, is it 3 cuts or is it 2 or 1? But it's really going to be the reasons why they make fewer cuts. If the economy is resilient and inflation is not accelerating, so they end up doing even as little as 0 cuts, that's actually quite bullish because, one, the Fed still has a lot of firepower to make future cuts, and it just shows you the economy is handling higher rates pretty well. I think it would speak really well for equities if the Fed made fewer cuts, but for the right reasons.
To the extent,
So that's the important part. That's the important part I think a lot of people still aren't understanding. They want the Fed to cut so bad. They think that's going to be great news, those sorts of things. Listen. Look at history. What does history tell you? When the Fed starts cutting, usually means recession's coming. You could look at look at the past 20, 30, 40 years, and you're going to find almost every single time the Fed starts cutting, a recession happened very shortly after. So if anything, you should hope the Fed doesn't cut anytime soon, right? That means we're staying in a very strong economy. That means the Fed's worry is inflation. That means the Fed's worry is too strong of an economy, right? That's producing this inflation, too many jobs, which is causing a wage price spiral. If all of a sudden the Fed has to start worrying about deflation, you know why that's going on? It's because you're in a recession at that point in time. Last time we really have seen deflation, you have to go back to, great financial crisis. We had deflation in 2009, right? Ask people how the economy was in 2009. Ask people how corporate earnings were. Ask people how the stock market was in 2009, right? 2009 is when the market finally bottomed. It was nasty.
Thesis depends on, obviously, earnings coming through. We're at the beginning of earnings season. What are you looking for both now and through the back half of next year in terms of S&P earnings and growth rate?
Well, earnings in the fourth quarter that was reported 3 months ago came in close to 8% above expectations. That's already flowed through into what we expect for 2025. First quarter's already looking pretty good. More than 80% are beating. So I think our 2025 earnings, which is officially 260, and that was 8% earnings growth, is probably low. It's looking like it's going to end up being closer to 270, maybe 275. That's a $15 higher earnings for next year just because of the strength of earnings we're seeing now. So I think profits are coming in pretty well. I mean, inflation's cooling, but companies are still finding operating leverage.
So there's something a little troubling I've seen out there. I saw CarMax stock across the board there, right? And this could weigh on Tesla, which we're going to speak about Tesla in this video, okay? Here's what I witnessed in Arizona over the weekend, and here's what I witnessed on my drive back to Vegas, okay? So when I was in Arizona, went by just this massive amount of car dealerships. When I was on the west side, this is kind of let's call it, this is between I think 83rd Ave and 91st Ave and Bell Road. If you're from Arizona, you know that area. If you're not, you don't know what I'm talking about, and that's fine. Just moral of the story is this is just a massive car dealership area. You've got Ford, you got Chevy, you've got Volkswagen, you got Audi, you've got Mercedes-Benz, you got all the big auto manufacturers. They're all on this particular road, okay? And I'm driving by looking at the lots, and they are as jam-packed can possibly get with vehicles. I haven't seen it like that in a long time, if ever. I could not believe how much inventory was sitting on those parking lots. It was ridiculous. I went by the Jeep lot, and I'm just like, how many Jeeps do they hope to sell? That's insane. And I'm just looking, and I'm like, dude, that's ridiculous. If I was running that dealership, I would just be like, how are we going to move all these freaking vehicles? This is insane, okay? And then coming back to Vegas, I went by all the dealerships that are there off the 215. If you know where I'm talking about, you know where I'm talking about, right? And I go, there's almost all the dealerships you could possibly imagine right there on that stretch of the 215. And I'm looking at those lots. And 2 years ago, those lots were near empty. I mean, they had hardly any inventory on them 2 years ago. And I'm going by them now, and they are just jam-packed like a can of sardines. And so this leads into, I think, some issues that are going to be coming for some of these automakers, where I think it's going to be difficult for them to move units because they got to sell into the dealership network, right? But the dealerships, to me, look, like I said, the most packed I've seen them certainly in at least 5 years, if not than I've ever seen. I can't even believe it. And if you work, if there's anybody watching this that works in the dealership, you got a lot of inventory to move out there. You're going to need a lot of people to buy a lot of cars. And this leads into Tesla, right? Tesla, we know obviously it's been a weaker environment, right? But the one kind of worrisome thing out there that's out of their hands is, man, I feel like these dealerships are going to have to do a lot of discounting over the next 6 to 12 months to move inventory. And I think there might be a little bit of desperation that will breed in over this next 6 to 12 months when it comes to these dealerships, right? Which is going to put more kind of downward pressure on pricing. I think Tesla, Musk and the whole team over there at Tesla, I think they've gotten out in front of this whole situation, right? Because they sell direct to consumer, so they feel it before, whereas a lot of these other guys, they just sell into the network and they just drop vehicles to the network, right? That's going to start hitting them, I think, this year. Whereas Tesla, everybody kind of to see it got hit last year, right? So we'll see how this shakes out. But man, I was like, geez, that's a lot of units to move there. Holy smokers, that's no jokers. Alrighty, guys, let's get into this.
It's temporary, a temporary moment of pain and a buy the dip opportunity. He joins me now, Post 9, to make that case. Good to see you again. I'm glad you're here in person, too. So you don't think that much changed this week?
I think the narrative got muddled because that CPI report was a disappointment, but it was driven by what we'd call stubborn components, shelter, auto insurance. The median core CPI component now has only 1.7% year-over-year inflation. Inflation is normalizing. It's just not evident in the total picture.
So the PCE in a couple of weeks is going to be more favorable, we think, than these.
I'm about sick and tired of this, okay? I'm about sick and tired of this. I've got to push back right now against all the bulls, okay? Because every time there's always a damn excuse. Every time, the numbers are only high because of this number, that number. It's always an excuse. We just have to admit it. Inflation is still an issue. It is not defeated. We can keep making up excuses. It's only auto insurance, and we're always just making up excuses. And we've been doing that for 2 years now. Okay? We just have to admit inflation is still an issue. We have not defeated inflation. We're in a lot better spot than we were, let's say, a year or 2 years ago. But the bottom line is this is not a slayed dragon yet. Okay? And so I get sick of the excuses. It's always an excuse. And then if next month comes in not that great, there's going to be some other excuse. And next month, it's like, holy smokes.
Inflation reads. And I know what everybody says about it being the Fed's favored measure on where inflation is. But are you entertaining the idea that this is not going to be as easy as you once thought it was going to be for this last mile, and therefore the market can't do what you once thought it could?
I'd say that's really the narrative disruption this week, because now the Fed has 3 inflation reports that it can't argue against that are a little hotter than expected.
And the bulls can't really explain them away either, can they?
That's right. So what we would need to see is April and May CPI improvements, which is in the future, and then keeps the Fed from standing in the way of the economy. What we don't want is a Fed that wants to further slow the economy, which is rate hikes. And I think if they just do even one hike this year, it's still actually a good environment for stocks.
One cut, you mean?
Sorry, one cut.
Yeah, let's be clear. See, that's a Freudian slip. Because the greatest fear of all is that they're going to have to hike again, however remote that possibility seems today. And even if you put into the soup all the Fed commentary that we've gotten of late, just seems to be push off rather than push up.
That's right. And I think it's, at the end of the day, it's even as CPI does look like it's somewhat sticky, PCE, as you pointed out, is more cooperative than PPI is, and measures like Trueflation show inflation much softer, inflation expectations much lower. So I think at some point we could also just ask, is CPI a bit aberrant?
What about the valuations of the market? How do you counter the argument that they're just way too stretched? Multiples are just way too rich, given what now is likely to be the case of cuts later on.
I think when someone looks at 20 years of history, that's the argument they'll make. If they look at 90 years of PE multiples versus interest rates, when the 10 years between 4 and 5%, which is a pretty big range, the median PE is 20 times. So we're not even at a median PE multiple of what's existed whenever the 10 years been in this range. So, and then if you look at the median stock, it's actually at 16 times. I'd say that there's upside to earnings. I think multiples can expand. I don't think 5,200 is the ceiling for stocks this year.
What feels like the right ceiling now?
I know this is going to be tough for investors to embrace it, but I think something like 5,600, 5,700 is probably where the S&P exits the year, maybe even higher.
Much more backloaded into that than you once thought?
I think it's still backloaded because we'll have the cuts behind us, and we'll have visibility into 2025 earnings, which probably could be 270, maybe 280 next year.
Well, when you say we'll have the cuts behind us, are you so sure? Right? So let's just take June off the table. For argument's sake, no June.
Yeah.
Hold on. Let me push back for just a moment here, okay? I do not like it when people assume valuation's already pretty dang high, okay? If you're looking at trailing 12-month P, forward P on the stock market, we're at very high ranges compared to where the market historically trades at, okay? So I do not like it if you're trying to hope that valuation is going to push up even more. The only way stocks should really go up considerably from here is by the strongest companies that matter the most to the market, beating their earnings, right? Exceeding their guidance, and then we can push the market up further and further. So let's say the Metas and the Nvidias and the Apples and the Microsofts and the Google McDougals and all these guys come in. They're going to report their earnings over this next 3-4 weeks, right? Let's say they all come in, knock it out of the ballpark, and they beat their numbers, they beat their guidance. Then boom, 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 we can keep heading up, right? Because then we're not counting on getting a valuation push, right? Multiples expanding. Then we're just counting on earnings coming in. I think anything else is kind of hoping for the wrong things. Let's hope the PE expands. We're not at a low PE. If we were trading at a 12 PE, then I'd say, okay, yeah, we got plenty of expansion here. We'll be at a 20 before we're in a normal market, but not where we're at right now.
You think the first one's in July?
Or it could be September. But
that's why I asked you if the move in the market that you just suggested is backloaded. Because
yes.
You're not going to get a big move until you see the first cut. At this point, now there's a lot of disbelief in the market.
That's right. And Scott, one thing to keep in mind is the probability of a June cut has been reduced, but it can come back if we have a good April and May CPI, because then it's going to put back into focus what is the trend in CPI. It does feel stubborn when you look at January, February, March.
All right, next one up here. Market bulls have gotten ahead of themselves. And one last thing I'll just push back on. I think at this point we've got to stop trying to predict when the Fed's going to cut. And the reason being is it's just everybody's been wrong. I don't know anybody that's been right about the whole Fed. It's like you think, they're going to probably cut, and then they don't, and then they don't. And so at this point, I think it's a lost cause. At this point, it's a lost cause to even try to predict when the Fed's going to cut. Because, we've all been wrong. There hasn't been one person that's been right in regards to this whole situation. So it's kind of a fool's game almost at this point in time, in my opinion, in trying to predict these cuts. They'll come when they come, and they're likely going to come when we're getting substantial economic weakness. Next one up here, market bulls have gotten ahead of themselves.
CNBC contributor Avery Sheffield, co-founder and CIO of Vantage Rock. She and our senior markets commentator Mike Santoli are here with me on set. It's good to have you with us today. Avery, I begin with you. Did anything meaningful change?
Let me push back against this sentiment that market bulls have gotten ahead of themselves. How have market bulls? Is there just some crazy flood of money coming out of treasuries and savings and going into the stock market? The answer is no. Have we seen something happen in the market where people are going crazy on margin and margin out a ton of money, and we got a very high, percentage of the S&P 500 that's margined out right now or something like that? No, those numbers aren't high either. So this kind of sentiment about market bulls are out of control or something like that, we're not seeing the activity in terms of money flows and those sorts of things that you'd usually see. Have small caps been running? No. Small caps, if you're talking about the stock market's out of control, that's usually a situation where the Russell's going insane, speculative stocks are going insane. That's not what we have at all. Speculation is dead in this market. Anything speculative has sucked, just to be quite frank. The only companies that have really been performing well are the companies that really got it like that. They got that great top line and bottom line.
This week for the bulls?
I think the bulls began to recognize that, you can't have your cake and eat it too, right? So the market has been looking for lower unemployment, lower costs, lower rates, lower inflation, and at the same time, looking for growth enabled by higher wages, higher prices, and higher government spending. And the reality is the last part of that's coming to reality or continuing, and that means inflation's higher for longer, and it kind of makes it harder to have these low rates continue to have low rates come soon enough to stimulate the economy for the next leg up.
Should we be less bullish than we were? Did the game change in some respects this week because of the inflation reads that we got?
Yes. Well, I think that the bulls have gotten ahead of themselves, right? Valuations have been expanding. If year over year valuations are up 25%, while earnings estimates are actually about flat. And even over the past several months, you've continued to have valuation expansion with going from the expectation of rate cuts to nearly 6 to under 2.
This is poor analysis. There's poor analysis. Let me see if you guys can spot this. This is poor analysis 101.
That's right. Valuations have been expanding. If year over year valuations are up 25%, while earnings estimates are actually about flat.
Earnings estimates, okay. So one way, let me explain to you guys the high level stuff here on how she just screwed up massively, okay? She just compared the entire market to, we've seen the market do so well, right? We've seen valuations expand. Where we've actually seen valuations expand, where have we actually seen the performance of the market, the alpha in the market? It's been with the highest tier stocks, right? The Metas and Nvidias and those sorts of companies. Well, if you want to go ahead and split the Mag 7 in those very top tier stocks, let's call it the top 10, 20 stocks of the S&P 500 that are really the best performers, split those off from the market, and what you'll find is valuations are very low in terms of trailing 12-month PE, forward PE for the rest of stocks, right? So it's really the top of the market that's been helping out everything, and that's where you're getting that alpha, that performance. And if you look at the weaker stocks, they're not performing that great. Look at the equal weight S&P 500 versus, let's say, the Mag 7 over the past year, over the past 18 months. And you're going to see an insane divergence, okay? So her analysis there is just not good analysis. You got to go much more nitty gritty than that to get more of a full picture. Her analysis there, in my personal opinion, it's a flawed way of looking at it, man. It's a very flawed way of looking at it.
And even over the past several months, you've continued to have valuation expansion with going from the expectation of rate cuts to nearly 6 to under 2. So, something needs to give. And
the main stocks you've seen valuation expansion are the same exact companies that are not just coming in line with earnings expectations, that are blowing them out of the water, right?
I think it's the markets that are giving, and then you add on to that, increased geopolitical risks, and it's a tougher environment.
Okay, Bryn, you want to tell me what the takeaway is thus far for what's been a pretty turbulent week?
Yeah, I think that as the week started...
CarMax. Do you see the way that stock's down? Let me tell you guys. So, I was in Arizona this weekend, right? I went down was on the west side and going by all these car dealerships, right? And there's everybody on this road. There's Ford, there's Chevy, there's Volkswagen, there's Audi, there's Mercedes. Everybody's on this Jeep, everybody, Dodge. They're all on this particular street, right? I'm going by those dealerships, and you know what I see? Those lots are jam-packed. Like, I have not seen them maybe ever, but in probably a long time. Like, let's call it 5-10 years. I have not seen literally auto dealership lots packed like that in terms of just ridiculous amounts of inventory. Then coming home, driving back here in Vegas, looking off the 215 at those dealerships, all those dealerships lined up there off 215, loaded with inventory. Those lots are freaking maxed out. They got those vehicles like a can of sardines, row after row after row. There might be some issues coming, okay? It might be some issues with some of these auto dealerships, with some of these automakers that haven't really got hit yet in terms of the volumes really the way you would think they... Tesla, see, this is the difference between Tesla and the rest of these guys. The rest of these automakers, they sell the dealership network, right? So they've kind of flooded inventory out there, and I think it's kind of goosed their numbers to make them look like they're doing better than what they're really doing in reality. While Tesla's selling direct to consumer, it's a whole different business model. So don't be surprised if the traditional automakers report absolutely horrible numbers for the rest of this year. Don't be surprised. Now, am I going to go out there and short them? Might be tempting. I probably won't. It is tempting to buy some puts, but I probably won't because they're already such low valuation names. It's like a lot of times it just doesn't make sense. But don't be surprised if for the rest of this year, those companies report bad numbers.
Ending. I think it's definitely going to be risk off. We don't want to see Iran and Israel get into any type of skirmish. And I think that's also, gold's down a little bit today, but gold's had a huge run. And so I think people are putting their hedges on. And I think, in addition, it's like we started the year, Scott, with 6 rate cuts and an AI euphoria. I think AI is getting a little bit tired, consolidating, and we're going to now have maybe 1 cut in December or what have you. And so I just think the market's repricing. But I think today specifically is more geopolitical as well as yields going higher.
These are good points that are being made, Mike, and that if you were really bullish months ago on the idea that you're going to get rate cuts, and that was going to be a principal part of the story, how can you possibly be as bullish today on the idea you're going to get fewer?
It's more complicated. We were operating on the premise that we might not have to make painful trade-offs and give up the idea of the Fed easing into record high stock market, 3% GDP economies. That's something I've been saying for a while. I do look at it a little bit more about the atmospheric conditions that preceded this moment, which is the market straight up for 5 months, no 2% pullback in the S&P 500, a very tight clustering of the consensus around the soft or no landing, and yet we're going to have the Fed cut and rate and yields are going to stay tame and all of that. So I think we've gotten a pretty welcome shakeup of that opinion. And so if you had more, you have to have less conviction now in any of those views than you did 2 weeks ago. That being said, I'm not going to get too overexcited about a 0.02 of a percentage point, upside in CPI month over month that all of a sudden tears up the entire premise of how we got here. PCE is going to be under 3% annualized coming up in 2 weeks. And you're going to be able to kind of make both cases for a little while here, that the economy's fine, earnings are going to be better than expected in the first quarter, even if they're just getting back to what we thought they were going to be 3 months ago. And so we're less than 3% from the highs. We had our first 50-day moving average test in the S&P, again, in 5 months. That was a really long stretch. So I think you've lost the momentum players. That's broken. I think that you've lost the valuation doesn't matter because we're going to get rate cuts camp. And what you have to do is have a fresh eyes on valuation relative to earnings and also the big secular themes. Because every time we think this market is getting a macro gut check, somebody says AI and three mega caps go flying, and all of a sudden we think it's back to happy days again.
So in terms of the whole AI, is AI played out, tired, those sorts of sentiment. Earnings. If these companies come in, the Palantirs, the NVIDIAs, the AMDs, and report some pretty insane numbers, right? Great earnings that beat expectations, great guidance that beat expectations, great commentary, you'll find out that it has not played out at all, right? Now, if they come in and disappoint, sure, then it's really a played out story. But if they come in, knock out the ballpark, past quarter, future quarter, great conference calls, you'll find out very quickly, this is not a played out story yet. And next thing you know, NVIDIA will be 1,000 plus, and people will be paying $1,200 for that stock quickly. Palantir will be 25 plus, right? So yeah.